In an era defined by health trends and dietary fads, the protein craze has taken center stage, fueled by social media influencers and prominent health professionals alike. From protein-enriched snacks lining grocery store shelves to viral claims about protein deficiency, the conversation around protein intake is heating up. Recently, a comprehensive fact-checking initiative by the New York Times scrutinized 6 major claims about protein, offering insight into the nutritional landscape and the science behind these assertions. The discussion began with a striking observation. A 2024 survey revealed that 71% of American adults were attempting to increase their protein intake, a notable rise from 59% just 2 years prior. Influential voices such as Dr. Elie Jarrouge and Dr. Gabrielle Lyon have publicly challenged federal dietary guidelines, suggesting that current protein recommendations are insufficient. Dr. Attia, a well-known physician and author, has gone as far as to advocate for protein consumption nearly 3 times the current federal recommendations. This provocative stance, however, raises critical questions about the validity of such claims. An analysis of the federal recommendation, which suggests that adults consume at least 0.8 grams of protein per kilogram of body weight, reveals that these guidelines are generally adequate for most healthy individuals. For instance, a 150-pound adult would require about 54 grams of protein daily, equivalent to an 8.5-ounce chicken breast. While some proponents argue for an increase to 1 to 1.2 grams per kilogram, nutrition experts caution that the existing recommendations are based on a broad population study and serve to prevent deficiencies rather than optimize muscle gain or overall health. Contrary to the narrative that most Americans are protein deficient, data indicates that the average male exceeds the recommendation by 55%, while the average female surpasses it by 35%. Experts like Nancy Rodriguez, Professor Emerita of Nutritional Sciences, assert that individuals consuming a balanced diet are likely meeting their protein needs. However, groups such as teenage girls, women, and older adults may require more attention, as they are at a higher risk of falling short of the recommended intake. The conversation shifts when discussing muscle building, where a higher protein intake is often deemed beneficial, particularly for those engaged in strength training. While some experts suggest that athletes might need up to 3 times the federal recommendation, most studies indicate that an intake of 1.5 to 2 times the baseline is sufficient for muscle growth. Nonetheless, there remains a need for further research to conclusively determine the ideal protein levels for different populations. As for aging adults, emerging studies hint that increased protein consumption could mitigate age-related muscle loss, though findings remain inconsistent. European nutrition experts recommend that individuals over 65 should aim for at least 25% more protein than the U.S. guidelines suggest, especially during recovery from illness or surgery. The claim that high-protein diets facilitate weight loss is supported by some short-term studies, which have shown that higher protein intake can enhance fat loss while preserving lean muscle mass. However, results vary in longer studies, indicating that while protein can be a helpful component in a weight loss regimen, it is not a panacea. In the midst of this protein frenzy, experts caution against the notion that more is better. Overemphasis on protein can lead to dietary imbalances, pushing out other essential nutrients. Additionally, excessive protein intake may pose risks for individuals with pre-existing kidney conditions. As Dr. Wayne Campbell of Purdue University aptly summarizes, the quest for the ideal protein intake must find a balance, one that meets individual health needs without crossing into excess. The conversation surrounding protein intake is evolving, driven by both science and social media narratives. As more research unfolds, it will be crucial for consumers to discern fact from fiction, ensuring their dietary choices are informed by evidence rather than trends. As we look ahead, the quest for clarity in nutrition, particularly concerning protein, promises to remain a focal point in health discussions. In a significant development that underscores the turbulent intersection of governance and policy, the acting head of the Internal Revenue Service (IRS) has announced plans to resign following a controversial agreement to share taxpayer data with immigration authorities. This decision reflects a growing tension within federal agencies concerning privacy rights and the implications of data sharing on vulnerable populations. The announcement made on April 9, 2025, has stirred considerable debate among lawmakers and privacy advocates alike. Critics argue that the move to share sensitive information with immigration enforcement could undermine trust in the IRS, particularly among immigrant communities. This agreement jeopardizes the confidentiality that taxpayers expect from the IRS, stated a leading privacy advocate, highlighting fears that individuals may hesitate to file taxes if they believe their information could be used against them in immigration proceedings. The implications of this decision extend beyond individual privacy concerns. It raises questions about the role of federal agencies in enforcing immigration policy and the potential for overreach. The IRS, traditionally viewed as a tax collection agency, now finds itself at the center of a politically charged debate that intertwines fiscal responsibility with immigration law enforcement. This shift could set a precedent for future collaborations between federal agencies, further complicating the landscape of privacy and data protection. Meanwhile, political dynamics are also shifting, as many lawyers who have represented former President Donald Trump in his various legal battles are reportedly stepping away from these cases. This exodus comes amid growing scrutiny over the legal strategies employed by his defense team, particularly as the Supreme Court prepares to address several contentious issues. Legal experts suggest that this trend could weaken Trump's defense and complicate his ongoing legal challenges. The departure of seasoned attorneys raises serious questions about the viability of Trump's legal strategies moving forward, commented a prominent constitutional law scholar. In a related development, the stock markets experienced a notable surge following Trump's announcement of a 90-day pause on many tariffs. This unexpected move was celebrated by investors as a potential easing of trade tensions, prompting optimism in various sectors. Economic analysts believe that this pause could provide a much-needed respite for businesses grappling with the impacts of tariffs, allowing for a reassessment of trade relationships. As these events unfold, the intersection of law, policy, and economics remains increasingly complex. The resignation of the IRS chief, the departure of Trump's legal team, and the temporary halt on tariffs illustrate the dynamic nature of contemporary governance. Looking ahead, observers will be closely monitoring how these developments influence broader political narratives and economic policies in the coming months. The implications of these shifts could resonate through 2025 and beyond, shaping the future landscape of American politics and governance. In a tumultuous climate for the luxury fashion industry, the potential acquisition of Versace by Prada is facing significant jeopardy. Recent financial upheavals and market uncertainties have raised alarms, with experts from various sectors predicting a rocky road ahead for the proposed deal. According to a report by the Wall Street Journal, the ongoing volatility in the market could be a critical factor in the potential collapse of this high-profile transaction. Sources close to the negotiations have indicated that the Prada-Versace deal, estimated in the range of billions, is now under serious scrutiny. The fashion sector is no stranger to economic fluctuations, but the current market turmoil, exacerbated by geopolitical tensions and fluctuating consumer confidence, has left many in the industry questioning the viability of such large-scale deals. The luxury market is experiencing unprecedented challenges, and this acquisition is now more fragile than ever, stated a market analyst who preferred to remain anonymous. Compounding the situation is the broader economic backdrop, which has seen stock markets swing violently in response to shifting political and economic narratives. As of April 9, 2025, the Dow Jones Industrial Average and the S&P 500 saw a notable surge, which some attributed to recent comments from former President Trump regarding a 90-day pause on certain tariffs with China. These developments, while potentially stabilizing for some sectors, have not quelled the fears of luxury brands that rely heavily on international markets and consumer sentiment. While Prada and Versace remain committed to the discussions, the ongoing uncertainty raises critical questions about the future of luxury acquisitions. Industry insiders suggest that without a swift resolution to market instability, the allure of such mergers may diminish. In times of economic uncertainty, we often see companies retracting from ambitious expansions, remarked a leading financial consultant. Prada's interest in Versace could very well be a victim of the current climate. Meanwhile, the luxury sector faces additional challenges that extend beyond the immediate market fluctuations. The recent departure of the acting IRS chief has further complicated the regulatory landscape, leaving companies in doubt about future tax implications that could affect their financial strategies and growth plans. This turmoil within regulatory agencies adds another layer of complexity for luxury brands contemplating mergers and acquisitions. As the situation unfolds, both Prada and Versace are likely to intensify their risk assessments and market evaluations. Future developments in this acquisition saga will depend heavily on external market conditions and the company's ability to navigate these turbulent waters. Stakeholders in the luxury fashion industry will be watching closely, as the outcome of this deal could set precedents for future acquisitions and reshaping the luxury landscape. In conclusion, while the potential acquisition of Versace by Prada is a captivating narrative in the luxury fashion sector, the unfolding drama is a stark reminder of the intricate interplay between economic conditions and corporate strategy. As market forces continue to evolve, the fate of this deal remains uncertain, positioning the luxury fashion industry at a critical crossroads. In a significant development within the luxury fashion sector, Italian fashion group Prada has negotiated a reduced purchase price of $1.38 billion for Versace, slicing $200 million off the original asking price. This adjustment comes in the wake of the economic turbulence caused by U.S. President Donald Trump's recent tariffs, which have sent shockwaves through the market and raised concerns about the profitability of luxury brands. The finalization of the deal is expected to be announced imminently, with sources indicating that the original valuation of around $1.6 billion was no longer tenable given the financial pressures facing Versace. Capri Holdings, the current owner of Versace, has seen its share price plummet by over a third since the imposition of the tariffs, which has eroded the group's market capitalization to approximately $1.5 billion. This decrease in value has prompted negotiations that underscore the volatile interplay between international trade policies and corporate valuations. Capri's CEO John Idol is reportedly in Milan to finalize the details with the Prada family, although both companies have refrained from commenting publicly on the ongoing negotiations. The discussions have been complex, with initial hurdles including Capri's asking price of €3 billion and uncertainties surrounding the future of Donatella Versace, who recently stepped down after 3 decades as the creative director. Her replacement, Dario Vitali from Miu Miu, is expected to lead Versace towards a revitalization that aligns with Prada's high fashion ethos while appealing to a younger demographic. The impact of the tariffs has been stark. Versace's sales dropped nearly 11% in the last quarter, pushing the brand into a loss-making position. This decline has been attributed in part to Capri's strategy of licensing many of Versace's products to third parties, which has diluted brand equity. Analysts suggest that the merger with Prada could provide the necessary resources and vision to rejuvenate the brand, although the road to recovery may be fraught with challenges. The broader economic context surrounding this deal is equally significant. Trump's tariffs have affected various sectors, including luxury goods, as they increase the cost of imports and disrupt established supply chains. This geopolitical landscape has forced companies to reconsider their business strategies and financial forecasting. Capri's move to divest from Versace aligns with an urgent need to refocus its portfolio amid declining revenues from its flagship brands, including Michael Kors, which comprises about 70% of the group's revenue. As markets react to the shifting dynamics of global trade, there are implications beyond the luxury fashion sector. The recent fluctuations in U.S. stock prices, as well as investor sentiment toward corporate credit markets, reflect a growing anxiety about the future of trade relations and economic stability. The prospect of further tariffs and trade negotiations could continue to influence market behavior, prompting companies to adapt rapidly. Looking ahead, the Prada-Versace deal is not only a reflection of current market conditions but may also shape the future landscape of luxury fashion. As the industry grapples with the challenges posed by tariffs and changing consumer preferences, strategic mergers like this one could play a crucial role in ensuring longevity and success in a competitive marketplace. Investors and industry observers will be closely monitoring the outcome of this transaction, as it may serve as a bellwether for the broader economic ramifications of ongoing trade tensions. In an era marked by rapid technological advancement, the intersection of big tech and environmental sustainability has become a contentious issue. A recent investigation by Source Material and The Guardian has unveiled a stark reality. Major tech companies including Amazon, Microsoft, and Google are constructing data centers in some of the world's driest regions, raising critical concerns about water usage and its implications for local communities already grappling with water scarcity. The investigation highlights that these tech giants are not only operating but also planning to expand their data center operations in areas where water is a precious and diminishing resource. For instance, Amazon's proposed data centers in the Aragon region of northern Spain are licensed to consume approximately 755,720 cubic meters of water annually, enough to irrigate 233 hectares of corn, a staple crop in the region. These facilities, vital for cloud computing and AI training, require significant water for cooling, exacerbating the strain on local water supplies. Lorena Giampolossi, founder of the Ethical Tech Society, emphasized the gravity of the situation, stating, "The question of water is going to become crucial. Resilience from a resource perspective is going to be very difficult for those communities." This sentiment is echoed by internal dissent within Amazon, where sustainability experts have raised ethical concerns regarding the company's water consumption practices. Despite these criticisms, tech companies defend their operations. Amazon and Google assert they consider water scarcity in their planning. However, Microsoft's silence on the matter raises eyebrows. According to Source Material, a staggering 42% of Microsoft's water usage comes from areas experiencing water stress, while Google reports that 15% of its water is sourced from regions of high scarcity. These figures underscore the urgent need for a balanced approach to data center expansion, particularly in arid regions. The strategic choice of location for data centers is not merely a logistic decision, as explained by Giampolossi. It's no coincidence they are building in dry areas. The desire for low humidity to mitigate corrosion risk often leads companies to select inland sites, further complicating local water dynamics. In regions like Aragon, where climate change has intensified drought conditions, the approval of new data centers has sparked outrage among local farmers and environmental activists. Chechu Sanchez, a local farmer, expressed concern that the data centers are draining essential water resources, stating, "They consume water. Where do they take it from? They take it from you, of course." Amidst this backdrop, the tech industry's commitment to becoming water positive by 2030 has been met with skepticism. Companies like Amazon, Google, and Microsoft have pledged to offset their water consumption by investing in water accessibility projects. However, experts argue that water offsetting does not equate to responsible resource management, as local water issues cannot be mitigated by interventions in other areas. Aaron Wemhoff, an energy efficiency specialist, pointed out the fundamental differences between carbon and water management. Improving access to water in one area does nothing to help the community that has lost access to it far away. As these tech giants forge ahead with their expansion plans, the implications for local ecosystems and communities are profound. The pressure to balance technological growth with environmental stewardship is mounting, and the stakes have never been higher. The situation in Spain serves as a cautionary tale, illustrating how unchecked expansion in the tech sector can lead to ecological collapse. Looking forward, the ongoing discourse surrounding data centers' water usage and sustainability will likely shape the future of tech development, as communities demand accountability and transparency. The industry may be compelled to adapt its practices and prioritize sustainable solutions. The challenge lies not only in technological innovation but also in fostering a more equitable relationship with the environment and the communities that sustain it. In a significant boost to community infrastructure, the City of Scranton has secured a $1 million grant dedicated to the renovation of Cloverfield, a popular recreational area on the city's west side. This funding, part of the Pennsylvania Department of Community and Economic Development's Main Street Matters initiative, aims to enhance public spaces and promote healthier lifestyles among residents. Mayor Paige Gebhardt Cognetti expressed her enthusiasm about the project, stating, "This is a big win for our community. The Cloverfield renovation will provide more accessible recreation options in West Side for residents of all ages." The grant approval, announced on April 8, 2025, was made possible through the collaborative efforts of local state representatives Kyle Donahue and Bridget Koziorowski, who emphasized the grant's potential to transform the community. The Cloverfield improvements include the development of a dog park, playground, and courts for basketball and pickleball, alongside essential upgrades for grading, drainage, site access, and parking. The project is particularly timely given the recent history of Cloverfield, where a fire deemed arson by local authorities damaged its fieldhouse 2 years prior, leaving the structure slated for demolition. In addition to the Cloverfield grant, Scranton has been awarded $1.93 million in total funding, which includes nearly $881,000 allocated for a housing development project led by the United Neighborhood Community Development Corporation. This initiative aims to revitalize the Pine Brook neighborhood through the construction of 41 units of affordable housing, addressing the pressing need for quality residential options in the area. Koziorowski highlighted the importance of this project, stating, "This funding will assist with the acquisition and preparation of sites in Pine Brook that will provide for better housing options along this vital corridor." The overall investment in Scranton is expected to have a profound impact on community life by enhancing recreational opportunities and improving housing conditions. Chris Hughes, the city's communications director, reiterated the ongoing commitment to parks and public spaces, asserting, "We're doing a ton with the parks." As the city moves forward with these projects, they reflect a broader effort to invest in urban infrastructure that fosters community engagement and promotes public health. Looking ahead, the Main Street Matters program continues to underscore Pennsylvania's commitment to revitalizing local economies and improving community infrastructure. As Scranton embarks on these renovations and developments, the potential for increased community pride and connectivity appears promising, positioning the city favorably for continued growth and revitalization.